Okay, hi everyone. Well, today's video is on IPOs. What is an IPO? Let's tell you what it stands for first, and then we'll get into it. But the IPO stands for Initial Public Offering. Okay, and these words have some meaning. Initial, of course, means it's the first of its kind. Public means to the general public, or not private. And offering is just, basically selling shares of stock. Okay, so there's a little bit of detail about what the IPO stands for, initial public offering. It's the first offering of shares to the general public, right? So let's draw a balance sheet really quick because that's going to help us with a little frame of reference here. We'll draw our balance sheet, and if you haven't watched the video on balance sheets, you might want to do that. Okay, so there's our general balance sheet that we're used to. We have assets over here. We have liabilities here. And we have equity down here. And when we're talking about an IPO, we're really talking about the assets section of the balance sheet and the equity section of the balance sheet. And here's why. When an IPO happens, essentially what the company is doing, and by the way, IPOs are really only done by corporations. Corporations do IPOs, okay? And real quick, the primary reason to do an IPO is to raise capital. There are some other reasons, which we will get into here in a few minutes, but the primary reason to do an IPO is to raise capital for the business. And the business may use that capital for a variety of reasons. It might use it to expand, their plants, to do more R&D or research and development, open a new location, all kinds of things. Anything you can think of that the business really needs to grow and prosper, the capital it raises from this IPO can help it do that. And so when a corporation goes through an IPO, two things really happen. It sells shares to the public, and those shares are down here. And in exchange, the public pays them cash, right? So here's the company. Here's a potential investor or shareholder over here. So the shareholder will pay dollars, and the company issues a share to the shareholder, okay? And then, of course, then the shareholder hopes that the value of those shares go up in value over time. And that's how a shareholder earns a return on their investment. Meanwhile, the company is able to use these dollars. So here's the dollars, that the shareholder put into the company, and here's the share that the company gave to the shareholder. Okay, so you can see how this transaction up here is reflected on a balance sheet of the company, and we have an increase in dollars, and we have an increase in equity here. And so that's how our balance sheet continues to balance. Okay, so now it's important that a company could have had private stock before. And what that means is before a company goes, before a company goes public, it's still able to issue private stock. And typically the private stock will go to the founder, people who started the business, the founders, early investors, and so forth. And there are a number of special rules that go along with issuing and purchasing private stock. But once we get to the initial public offering stage, again, the whole point here is to be able to offer those shares to the general public. And one other thing that happens, that's different than when private stock is issued, is an IPO really creates a market for the shares. So if you had been a founder and you received private stock early on in the company's existence, you might not be able to sell it. Sell You might not be able to sell it. But once an IPO happens, then there's a market, and what the word we use here is we call this liquidity. Now it's not always guaranteed, but it happens in most cases, where once the shares are available for purchase and sale by the general public, then these folks who were once private shareholders can now sell their shares a little bit easier. And of course, people who purchase the shares up here, just as if you were to purchase a share of Coke, if you buy it on Monday, you can sell it on Tuesday, and there will always be a buyer for your share. Now, it might not be the price you want, but in most cases, you can get rid of the share if you need to. So we talked about what companies will do. You can expand plants, you can invest in research and development, you can open new locations. It might be investing in new technology, any of those kinds of things. Okay, now the last thing I'll mention, and then we'll head off to another video on IPOs and public shares. But once this initial transaction takes place, once this transaction up here is finished, in other words, the company in the IPO, so this whole thing is the IPO, issues the shares to the public and gets money back in exchange, and hopefully that company will sell 100% of its shares. All right, then the company gets all the money from that initial offering. So let's just say they were going to issue 1 million shares in their IPO, and they were successful in issuing them at $10 a share. Right, so 1 million shares at $10 per share means that they would have raised $10 million. Okay, so over here they'd have $10 million in cash, and they would have issued 1 million shares. 1 million shares at $10. So they would have $10 million in shareholders' equity. Shareholders' equity. Okay, so now these million shares are out there floating around in the public, right? So let's say you bought one. Okay, this is you, and this is me. And at some point, you say, you know what? I'd like to get rid of my share of stock in the company, and you sell it to me. So you paid $10, and let's say you sell it to me, and I'm willing to pay $11 for it. Now, this is kind of simplistic, and of course, it doesn't really happen this way, but I'm just trying to illustrate a small point here. So this $1 increase, who does that go to? Who does that belong to? Does that come back to the company? Does the company somehow share in that $1? Well, no. The $1 goes to you. If you purchase it for 10 and you sell it for 11, that $1 goes in your pocket. And so the point here is that once the IPO is over, all the trading of the shares that happen afterwards do not affect the company's balance sheet. Now, it certainly impacts the company in other ways. In other words, if their stock price is falling, it's usually a bad sign for the company. On the other hand, if the stock price is rising, it's typically a good sign that folks in the marketplace have confidence in the company's ability to generate profit and grow and prosper. But this $1 profit really belongs to you. And in exchange, if I turn around later and I want to sell it, but for some reason something's gone wrong and I can only get $9 for it, then that $2 loss belongs to me. I've just lost $2. And that's a loss for me. So again, that loss doesn't have any impact on the company, just as the gain didn't have any impact on the company. So, okay, well, there's a quick tour around IPOs. Again, initial public offering. It's the first general public selling of shares in the company. IPOs are done by corporations. And the primary purpose is to raise capital for the business to do a variety of things. IPOs are different than issuances of private stock, which we'll talk about in a separate video, which are much more regulated, by the way. And the way that the IPO works is to increase cash when the corporation sells the stock, and to increase shareholders' equity down here. And that's how that transaction ends up being in balance on the balance sheet. Okay, well, that's all the time I have. We'll see you in the next video.